talking about the state of the economy, the Fed, and sort of where markets are headed from here after a very busy week for corporate data, but also a busy week in the world of central banking and economic data. Joining us now to discuss is Mohamed El-Erian, President, Queens College, Cambridge University, and Chief Economic Adviser at Allianz. Mohamed, great to talk with you once again. Let's begin with the Federal Reserve and what we heard from Fed Chair Jay Powell earlier this week. I think sounding a little bit more dovish after some fairly hawkish economic projections, perhaps back in June. How did you read his comments and the market's, let's say, muted reaction to sort of what we heard? If anything, maybe more of a risk-on type environment in the wake of that.
Good morning, Myles. Thanks for having me. Yes, he was more dovish than the statement, and that was a boost to markets, and rightly so, because what he basically told us is that we don't have to worry about growth. It's going to be solid. We don't have to worry about inflation. It will be transitory. We don't have to worry about elevated asset prices, and that he will maintain the 120 billion of monthly asset purchases for longer than the markets expected. The market now have pushed back the expectations of taper till the end of the year.
Mohamed, it's Julie. Good morning. It's good to see you. We got inflation numbers this morning, of course. We got the PCE deflator month over month in June. PCE deflator, up 0.5%, a little bit lighter, a little bit better than had been estimated. But I know you have been consistently on record saying you don't think inflation is transitory. What would you have to see that would sway you from that view?
So I think we need to keep an open mind. And that's particularly true for the Fed. In the old days, the Fed used to talk about the two tails of the distribution. It used to talk about insurance against both of them. Now we have become a one-sided Fed. This conviction that inflation will be transitory. It's a conviction. What we're hearing from companies suggests that we should have a more open mind. They're telling us about input costs going up, labor costs going up, transportation costs going up. They tell us they don't see the light at the end of the tunnel for these three things. They tell us they have more pricing power. So the only thing I'm saying is keep an open mind. And what I will look at is what companies are telling us. I would like companies to tell us that there's less cost pressure and that they don't feel inclined to increase prices. That's what would make me feel comfortable that inflation is transitory.
And so, Mohamed, how do you think about the bond market then? And Jay Powell himself, I wrote about this a few days ago. He said he's not so sure what to make of the decline we've seen in the 10-year. How have you thought about, that rally on the long end of the curve?
So if the Fed is going to be more dovish than people expected, if it will continue buying emergency level bonds at 120 billion, if it's going to continue buying mortgages, even though the housing market is red hot, then the bond market will respect that. You want to respect the buyer, especially when the buyer happens to be the Fed. Printing press in the basement, pursuing non-commercial objectives, meaning it is not price sensitive. And what you get are people buying ahead of that. Who's buying? Foreigners are buying. People with asset liability matching needs are buying. So what you really get is a compounding of the fact that the Fed is continuing to buy for longer than what most people think was going to happen. And indeed, quite a few people think they should be starting to taper now.
Mohamed, I want to switch gears because I want to get your thoughts on the sort of retail trading revolution, for lack of a better term. And of course, it's fresh in our minds because of the Robinhood IPO, which did not have a huge positive reception, right? How are you thinking about that trend, where we are in that cycle, and whether or not this represents an inflection point?
So I think it's wonderful that more people are getting involved in the stock market, especially the younger people. I think for the future of a market-based system, it is good that the younger people have a stake, that looking to understand how capital is raised, how capital is allocated. So I am actually very encouraged by this. I'm also encouraged by the fact that Robinhood has shown us that through smart interfaces, you can communicate with the new generation. What I do worry about is how people are investing. I worry a little bit that there's too much of a fad going on, that people tend to buy things because other people are buying things. Hopefully, there'll be a learning process. But I think, Julie, if we step back, we want broader participation in the stock market.
And so, Mohamed, thinking about the stock market then, and really valuations has been the conversation all year, particularly with most of the FANGs, all of the FANGs having reported their results, such a large percent of the market cap. Does the stock market, U.S. stock market, feel healthy to you at this moment in time?
Look, if liquidity continues to be so incredibly supportive, then yes, it is healthy. I am among the many people who are riding this wonderful liquidity wave, and it's been great. But we think tactically, and this is really important to understand. We recognize that at some point the wave may break. It was summed up best by Leon Cooperman when asked, how do you feel about this market? What are you doing? He said, I'm a fully invested bear. So he's bearish about the outlook, but he's fully invested for now. And that's the concern, is that if we don't start tapering early, you may end up having a massive shock, an unnecessary, disorderly shock to both the markets and to the economy.
And Mohamed, speaking of shocks, the last couple of weeks, we have seen a number of headlines related to Chinese regulatory actions that I think have taken a lot of U.S. investors by surprise. Does this concern you just in terms of, as analysts and strategists like to say, having visibility on this pocket of the market and whether we can trust so many of these businesses that have come indeed to the U.S. markets?
So there's two elements of contagion we should look at, and they are indirect. So I don't worry that there will be a cascading effect through the markets and the economy, but I keep an eye on two indirect effects. One is what I call the index effect. China has grown to be quite a big portion of the emerging market indices. And to the extent that China becomes less investable, which is what's going on right now, people may start selling the index as a whole. And then the second issue is we were all hoping for a rotation. The US leads, then Europe follows, and then emerging markets. What's happening in China is going to hold back the emerging market trade even more. So we're going to continue to rely on the US as a driver of global markets when a lot of people were hoping for some sort of rotation to keep it more balanced.
Mohamed, Brian here. I really enjoyed your latest FT op-ed, and you're talking at great length about crypto, and you say Western governments need to stop dismissing the crypto revolution. What should Western governments be doing then?
So I think both the crypto world and governments need to come together and talk a common language. We have in the crypto revolution really important innovations that have to do with the payment system. And we have to take that seriously. Why do we have to take it seriously? For two reasons. One, it can make financial intermediation more efficient. And second, if we're not careful, China, which is taking a very top-down approach, may start defining the agenda. Why do I say the crypto world as well? Because the crypto world has to take seriously concerns about illicit payments, concern about money laundering, and concerns about energy use. So it's time for them to speak a common language and try to channel what I think is a really important disruptive innovation in a way that actually helps finance and the society.
And what's the biggest risk of not doing that, of U.S. authorities sort of continuing in this line of sort of being skeptical of the crypto world?
So two risks. The internal risk is that the government will see adoption by the private sector, and we're seeing greater adoption by the private sector. We're seeing it every single day. So it's not something that's going to disappear. You'll end up with this very tense tug of war, which is unnecessary in my opinion. But the second more important issue is that China is not waiting. China has an image about what digital money looks like. It has decided it should have a top-down approach, and it has decided that it wants to export its approach. Why? Because it gives it access to payments platform regionally. It gives it access to data. So we have to take this seriously. Otherwise, we are going to lose the narrative completely.
And Mohamed, before we let you go, July is wrapping up. You know what that means, right around the corner. Zach Wilson, how are we feeling?
So I should ask you. I'm actually closing my eyes. The Mets are still in first place. The Jets look somewhat better. I don't want to jinx all this. I'll leave that to you. I'm not talking about it because I still can't believe the Mets are in first place at the end of July.
That's right. Mets and Jets fans know it's better to not talk about it, and then just in November you can go see how the Mets did, and it'll end up being better than if you watch all the way through.
And I have my handkerchief ready.
There you go. All right. Always appreciate the time. Mohamed El-Erian, President, Queen's College at Cambridge University, and the Chief Economic Advisor to Allianz. Mohamed, appreciate it, and then we'll talk soon.
Let's turn our attention back to Amazon. We've got Anthony Chicumba, Loop Capital Managing Director. Anthony, we were just walking through the numbers in the quarter, and I have to wonder if this is the stock move today. Is that just the case of investors really having these sky-high expectations, given the exceptional year that happened, or are there some warning signs flashing ahead?
I think that it's much more the former than it is the latter. I think that expectations were simply too high. And it's not just investor expectations. Quite frankly, I think internal expectations were too high. You have to remember that this is the first quarter that they were anniversarying the pandemic and the acceleration that they saw from the pandemic. And now things are normalizing, right? You have more and more people who have been vaccinated. They're starting to go back to their normal shopping habits. And I just think it was very difficult for them to forecast what the impacts of that would be on their business. So I don't think that this is necessarily, a warning sign for Amazon, but it does reset expectations down to a much more manageable level because you are going to have these very difficult year-over-year comparisons for the next few quarters.
Yeah, the comps are tough, as we know, kind of enjoying in that shift in the way people purchase things in the pandemic. But when you look at costs, that was the one thing I was, Keek and I were just talking about it. When you look at that, how worrisome is that maybe weighing on what the company can benefit from moving forward? Even if there is some stickiness in the way people shop, it seems like the costs of running the business and the warehouse staff, labor also a big question mark there. How might that weigh on quarters ahead?
When it comes to costs and Amazon, I worry a lot less about those because a lot of that is investments that they're making ahead of future growth, whether that's investments in final mile delivery, whether that's investments in AWS. And Amazon's track record of getting a return on their investments is quite good. So it's not something I'm necessarily worried about. Look, wage pressure is definitely a thing, but I think that they'll be able to at least partially offset that by higher revenues because if wages are going up, then prices of products are probably going to be going up as well.
So what do you think are the realistic expectations for Amazon moving forward? I mean, the reality is we have continued to see big growth for online store sales for the company. But we did hear from the CFO yesterday who said, look, people aren't just spending as much time online. I mean, when you talk about resetting expectations, is this more in line with what we're likely to see for Amazon moving forward, regardless of how they shift things around with Prime Day, regardless of some tweaking in terms of drumming up more interest within the platform?
So prior to the pandemic, Amazon was growing their top line in the sort of 20+% range. I think we're going to get back to more to those type of numbers, maybe even a little bit less than that, because the other issue with Amazon is just the law of large numbers, right? I mean, we just saw a third consecutive quarter in which they did well over $100 billion in sales. It's just hard to continue to grow at the rates that we've enjoyed in the past when you become that large. But one thing to consider, and one thing I was just sort of calculating. So Amazon, the earnings that they generated last quarter, so in the second quarter, was 2/3 of the earnings they generated for all of 2019. I mean, that's just a staggering number when you think about it. So yeah, is growth slowing? Absolutely. Should we expect that to continue? Absolutely. But let's not forget that this is a company that's just generating a ton of net income and continues to be a bigger and bigger player in our everyday lives.
Yeah, I suppose there would be alternatives for investors out there looking to invest in tech here. And as you noted in your reaction to what we saw on the earnings call there, bears might point to a drop in margin, particularly in the cloud business. So the cloud numbers from the quarter were stronger than expected. I mean, does that maybe point to some increasing pressure as Google and the like start to catch up on the cloud side? I know Microsoft's been pushing ahead on that front. I mean, is that maybe an area that there is some truth to increased pressure actually resulting on the company's financials this time around?
That's a great question. I mean, the cloud business was actually one of the bright spots in the quarter. Growth was 37% year over year, so that actually accelerated from the growth that we saw in the first quarter. In terms of the profitability, first off, remember we were anniversarying a really tough comparison. I mean, it's just tough to continue to do 31% operating margins. And I think that the declining profitability, a lot of it's just a function of mix. As Amazon goes after more and more kind of large enterprise cloud business, that's just less profitable business relative to getting another startup to host their servers on AWS. So it's not necessarily something that I'm concerned about. The other thing to think about in terms of cloud, it's not necessarily a zero-sum game. I mean, the total addressable market is massive, and it's only getting larger as more and more companies of all sizes realize the benefits of cloud versus on-premise.
And Anthony, finally, we're talking about Amazon today, but we've turned to you a lot over the last 6 months to talk about the meme trade. Obviously, somebody who used to cover GameStop. I'm just curious what you make of Robinhood's debut. We saw it decline 8% yesterday. Is this just a symptom of the structure of the IPO? I mean, what's your sense on why we saw a less than stellar debut?
Yeah, that's a great question. Look, I think it's a combination of a few different factors. I mean, one is that there are some real questions around this long-term sustainability of their business model, quite frankly. There's questions about pay for order flow. There's questions about, crypto and obviously they're trading a lot of crypto, but, who knows what's going to happen with that if crypto remains under pressure. And then it almost seems like with some individual investors, there was almost like a backlash. It was almost like their chance to get revenge on Robinhood for what happened in January, when they had to restrict trading in meme stocks. Now, what these individual investors don't understand, well, quite frankly, there's a lot of things that they don't understand. But that was not Robinhood's decision. I mean, it was based off of the companies that were clearing their trades, and they just didn't have the collateral. And they raised a bunch of money in a very short period of time to alleviate that. But a lot of these individual investors don't see that, and they're actually shorting Robinhood stock. So it'll be interesting to see how this plays out going forward.
Okay, we'll be watching. Anthony, it's always good to have you on. The company behind brands, Vans, Supreme, and North Face, among others, saw revenue grow more than 100% to $2.2 billion in the quarter. It did raise its full year outlook for fiscal 22, saying it now expects revenue to grow at least 30% to $12 billion. Let's bring in Steve Rendle, VF Corp's CEO. We've also got Yahoo Finance's Brian Sazzi joining in on the conversation. Steve, it's good to talk to you today. Certainly a very strong quarter. It feels like we have heard this from so many retailers that people are finally going back in store buying again. Where are you seeing the biggest strength across the brands?
Well, great. First, thank you for inviting me to be part of today's call. We're seeing broad-based momentum, and it's really across our portfolio of brands, but it's certainly across regions and channels. Probably, big strength that we talked about today is just the strength here in the U.S. and the strength in our Vans business. We're returning to pre-pandemic levels as our stores start to come back online, and we are able to connect with our consumers and really drive that experience that's so important through our bricks and mortar channel. Honestly, we think we're seeing a real benefit to our ability to connect based on our decision to not furlough any of our teams last year. But to keep all of our retail staff employed. They're back in our stores. They're driving, a lot of passion and connecting with consumers. And what's interesting, while traffic is still off historic levels, it is increasing month by month. Our conversions are stronger than historic levels, and we really do attribute that to our people and the commitment that we gave to them last year, and we're seeing that in spades today.
Steve, the wholesale business up 100% organically in the quarter. How is your fall and spring 2022 order book shaping up?
Brian, our order books are strong, and that is in large part part of the $200 million increase that we committed to today in raising our full year outlook. And we came into the year with strong visibility, and we were able to continue to add select amounts of increases with some of our key accounts, not just here in the U.S. But in Europe as well. So we're very happy with the momentum to be back at pre-pandemic levels and to raise our outlook that shows a plus 9% to fiscal 20 levels, and to raise earnings to $3.20, which is a 20% increase over fiscal 20 levers. Our model is really designed to deliver this level of growth. And with the 13 brands that we have in our portfolio, we talked about Vans and North Face and Supreme, but our Dickies business is doing extremely well. Our Smartwool and Ultra business, though small, gaining share and driving solid growth too.
And Steve, we've seen a real strong bounce back in the industrial economy and in many other places, and as a result, a strong bounce back in employment levels. How is the workwear side of your business doing?
Our workwear business is doing really well, Brian, and it did well last year, as many of those retailers were considered essential. And our Dickies business on a 2-year compare is up 25%. We saw good growth last year, and we continue to see growth. What's interesting, with both our Dickies and Timberland Pro businesses, is they are selling to that core, work consumer, but there's a lifestyle component, that is trending, with these two brands, and we see that with the channel expansions that we see with Dickies. Recent launch of a skate collection, and an elevated signature collection. Consumers are thinking beyond just that core application of work, but these brands help define who they are, and we really do drive that dignity of work and the pride that these people feel for who they are and the important work that they do.
Hey, Steve, Zach here. I mean, when we talk about boosting that fiscal 2022 outlook, it is interesting to see the stock down. Adjusted earnings per share pointed to 320, previously 305. And I wonder how much investors out there might be thinking that some of the updates might be conservative, given kind of the bounce back that you guys have seen in your brands. What is the confidence of the upped forecast that you could surpass it, given the fact, that this is strong? And I think right now people are looking ahead whether or not that bounce back is going to hold, considering there are only so many clothes you can buy once you have to get back to normal.
Well, I tell you, we're very confident in the outlook that we gave today. But I think it's important to note that our first quarter is less than 10% of our total annual revenue. So I think to raise outlook by $200 million and earnings by 16 cents after such a small portion of our year behind us, should really speak volumes to the confidence that we have in our business. And the momentum is building. There's a tremendous amount of demand built up here, pent-up demand here in the U.S., in Europe, in Asia, specifically China. Our brands are extremely well positioned. We're leaders, if not number one, in many cases. The products, the flow of new products, the strength that we've picked up over the last 12, 18 months and really driving compelling stories, to create more powerful experiences. We talked this year about Vans moving to a 52-week launch model. So every week there'll be a new product offer. Could be a broad global offer, could be a select small boutique offer, but we're providing visibility to all of our Vans consumers of what those new energy drops look like, where they can find them, and it's driving tremendous heat, and certainly giving us strong confidence in that long-term loyalty.
Well, it's nice to see the bounce back there. Steve Rendle, VF Corp CEO, it's great to talk to you today. Our thanks to Brian Sozzi as well for joining in on the conversation.
The Delta variant is wreaking havoc on companies' return to office plans. Apple and Google are among the latest to push back their return to office plans by a month from September to October. Employment website Indeed is taking it one step further, pushing back their return to office plans from September to January 2022. I want to bring in Indeed's Senior Vice President of HR, Paul Wolfe, to talk about a recent Indeed survey that breaks down what employees are saying about returning to the office. Now, Paul, you're an insider, you work in HR. What are employees saying about returning to the office in September? And do you expect that even more employers might be pushing back that September date?
You know, it's a challenge. The last 17 months have been a challenge for all of us, especially in the HR world. We surveyed 450 employees who have been working from home during COVID. Majority of them, 51%, are feeling good about returning to the office, but 71% of them remain concerned about the health risk related to COVID. The Delta variant, these new variants are far more contagious. I heard in a previous report, it's like they're as contagious as chickenpox, and that harkened back bad memories for me of having chickenpox when I was 21. The pandemic has also changed people's perspectives on what the office is for as well. You know, we've been forced to work from home during a pandemic and other things going on in the world. So this isn't a real work from home environment. But we've seen that 45% of employees now view the office as less important than they did before. And also we've gotten into our own routines. Like, I haven't commuted to the office for 17 months. We've been work from home for 17 months. I like the fact that I can have coffee with my husband and dinner with my husband, and you know, this has become part of my work day now, if you will, because I sleep and work in the same building right now. And we've seen that in this report as well.
And Paul, why has Indeed, your employer, decided to push back that return to office date from September to January 2022? How concerned are workers about the health risks?
Look, I think health risk concerns are at a peak these days because of this pandemic, and we're still learning about what's going on every single day. You know, we made that decision after talking to a medical advisor we've been working with for the last 14 months. And our guiding principle through the entire pandemic has been the health and safety of our employees. And that's why we made the decision to push back our return to the new way of working to January of 2022. We wanted to give some runway there. We wanted to allow for folks in countries that work for us where vaccine rollout isn't as robust as it is in the US to have an opportunity to get it. We've also heard from a medical advisor that a vaccine for the 5 to 11-year-old age range should be available in the fall. We have a lot of Indeedians who are parents, and they're concerned about their children who don't have a vaccine yet. So we took a lot of details into account, but really it's about the health and safety of our employees. We luckily are a technology company. We've been able to work effectively well for the last 17 months from our homes.
I'm struck by how little workers' top concerns about returning to the office have to do with their actual work. I've spoken to a lot of workers who dread having to commute back to the office, hop onto a train during rush hour just to get back in the office in the morning. What are you hearing about commuting? I know that you mentioned yourself that you haven't commuted in a while.
Yeah, so I'm in Manhattan. We're at our house about an hour north of Manhattan. I don't want to get back on Metro North and the subway to get to the office right now. And it's interesting, we've been doing weekly Q&As with our employees for the last year or so. And one of the questions that came up in the Q&A just this past Wednesday was about having to use public transportation in Manhattan in New York. We have an office of about 900 employees in New York. And that's a tough one because, you know, we've heard that the MTA in New York has done, you know, they're doing more cleaning and more filtration, but you are in a confined space with a bunch of people and you don't know vaccine status. So I think being cautious is the right way to go. But you know, there's the risk concern with getting on public transportation. And then there's also just the life that we've kind of gotten used to. There is not There seems to be a little bit more freedom. I think this has really taken the line between work and life out of the picture altogether. Because like I said, I work in the place that I sleep and live. I get my job done. And as long as my leader, who happens to be our CEO, is setting clear objectives with me and I'm getting my work done, do I really need to physically be back, go to that old paradigm of being in an office to get work done or be viewed as productive? And I think the answer we've all learned through the last 17 months for many of us is no.
Well, Paul Wolfe, the work paradigm has definitely shifted amid the pandemic. Great to have you on. Thanks so much.
In the first half of the year, more than 4,000 flight attendants had to deal with badly behaving passengers. That's all according to the Association of Flight Attendants. So let's bring in Taylor Garland, spokeswoman for the AFA, and our very own Adriana Belmonte. So Taylor, let's just start with these figures. Are they because, passengers right now are refusing to wear masks, or is there something else that's happening here?
So masks are certainly a part of it. It sets up a situation where flight attendants have to interact with passengers, but it's not just masks, it's alcohol and it's routine safety reminders. Some of the worst offenders have been started when a flight attendant reminded a passenger to fasten their seatbelt for landing or pull up their tray table. So masks are certainly part of the story, but they're not all of it.
So I'm just curious, you mentioned alcohol has been a big issue this year. Has anything changed exactly? I mean, obviously aside there's a pandemic, but I don't know, how much of an effect does that have on people's consumption of alcohol on a plane?
Well, alcohol was always a big issue for us with unruly passengers, even before the pandemic. And one issue that we've identified since the pandemic is the invention or broad usage of to-go cocktails in airports. Restaurants and things like that made different plans when people were trying to minimize or maximize social distancing. And so cocktails are much more easy to get and people can take them around the airport. So that's what we're seeing. The other thing is a lot of people are coming back to the skies and this is their first time flying or taking a trip in over 15 months. And it's a party atmosphere. And that has also led to an increase in the alcohol consumption.
So we've been seeing these variants just getting worse and worse, cases going up as well. And it seems like a lot of states are re-implementing their mask mandates. And I'm assuming that means that the rules will stay the same on the plane as well. So do you think that's going to, make things worse, essentially?
Well, one of the issues we've had always on board over the last 6-7 months is that the mask mandates, depending on what state you're from or locality, are different than what they are on the plane. Right now, there's a federal mask mandate in place through September 13th. And with the CDC's announcements this week, it's likely, though we don't know, it's likely that they will extend that on transit. It's not just airlines, it's also buses and metros, things like that. So hopefully this actually leads to more consistent communication because passengers will have to wear their masks in their grocery stores and around their normal town, as well as the airport and the airplane.
So I know that the FAA has begun implementing really severe fines for people who are unruly on the plane. Are there any other solutions that could potentially reduce these incidences?
So one thing we have been very encouraged by what the FAA has doing. FAA Administrator Dixon instituted a zero tolerance policy on January 13th, and that has been extremely helpful in getting fines quicker to people who act up on board. What we're also imploring with these results is for the DOJ to take action. The DOJ has the authority of the Department of Justice to criminally prosecute some of these worst offenders. And so we're really hoping that they take these issues up because there should be consequences when you act up on board, especially in a physical nature, which we saw in the survey. 17% of those responding said they experienced some type of unruly incident of a physical nature.
I'm a little bit confused, Taylor, because I already thought that assaulting a flight attendant or any crew member really could result in a felony conviction. I thought it was a violation of federal law. So are those laws, perhaps, are those folks not being really prosecuted to the fullest extent of the law? Or do you think that perhaps some of those laws need to be rewritten to be even stricter, perhaps give out even harsher punishments?
So we believe that the laws are in place to prosecute the people who commit these horrible offenses on board. What we're asking the DOJ is to really take these cases up quicker and make clear to the flying public that there are going to be consequences on the ground. Justice can be slow sometimes, but the issue is so severe that we're really imploring the Department of Justice to get on it.
So taking a look at FAA data, seeing the number of unruly passengers, how it's hit an all-time high, I'm just curious. I mean, obviously there's never been anything to this extent before, but have there ever been any other times in history where passengers seemed a little bit more difficult than usual?
So air rage is not a new thing. It's the worst it's ever been for sure, but our union started working on this issue really in the 90s. And that's when the FAA fines or the civil fines came about actually initially. And over the last 20 years, from early 2000s, we've increased those fines and also the criminal penalties that are in place. So we actually just upped the fines to $35,000 in the FAA reauthorization bill in 2018.
All right, we're going to have to leave that there. Hopefully, Taylor, the second half of the year is going to be a lot better than the first. And for everyone watching, please, flight attendants have so much to deal with. You being unruly on board the plane is the last thing that they want to have to deal with or worry about. Taylor Garland, spokeswoman for the AFA, Adriana Belmonte, thank you both for joining us. Joby Aviation has completed the longest test flight of an electric vertical takeoff and landing aircraft. That's an eVTOL to date. We're joined now by Paul Sciarra, Joby Aviation Executive Chairman. Paul, hopefully I can talk throughout this interview. I've been struggling today. So let's just talk about electric aircraft, because I know it's quite tricky since the battery has to have enough power to really get that lift off, but then also has to have enough juice and power essentially to complete the rest of the journey without still being too incredibly big. So how did Joby really find that balance in your aircraft?
Well, thanks a lot for having me on, Kristen. And as you noted from the outset, it's been a big week of milestones for the company. And one of those was certainly the demonstration of a 150-mile test flight on a single charge. I think showing, contrary to the way that many people thought, that the long range that we've talked about is possible with batteries that exist today. I think it's a real testament, frankly, to the engineering effort that's really played out over the course of the past 10 years in this company. Putting together the right pieces, the right sort of efficient electric motors, the right battery packs, the right underlying aircraft design to really deliver on the promise of air taxis for the first time. So the challenge is, as you mentioned, sort of ensuring that you have the right amount of power and that you're using it in the right way. And this test flight, I think, is a real testament to that work.
So I want to ask, because you guys are expected to bring some of these flights to market in 2024, what kind of flights can the public expect once those flights are brought to market?
So we've designed our aircraft maybe a little bit differently than others to really be suitable for any trips between 5 and 150 miles. So that's a pretty wide swath of trips. So that's trips inside of cities, say downtowns to airports, but also at the higher end of the range, really allowing us to connect cities to suburbs, and in some cases, cities to nearby cities. So the 150 miles that we demonstrated this week, that's a trip like San Francisco to Tahoe, doing it in a fraction of the time, at similar cost to taking a ride-sharing vehicle on the ground, and of course, we think at even greater safety. So the opportunity is really to deliver on that big, wide range of trips with just a single aircraft.
I want to ask, because you guys right now are based in California, but are there plans to bring some of these shuttles perhaps to the East Coast, to New York? I know the shuttle flight from New York to the Hamptons, for example, is a popular one right now. I've seen some of my friends have definitely made that trip. Are there plans beyond California right now?
So we haven't made any announcements of our launch cities, though I think we've told investors during our analyst day that we're going to be making some announcements on that front at the tail end of this year. And when we think about the opportunity for this aircraft and the service that's based on the aircraft, it's really not, we think it's really widely applicable. So, hey, it could be LA, could also be New York. There are cities like Miami that I think are also interesting. So we really intend to target our initial launch in 1 or 2 cities and then kind of grow from there.
What about cost? I know that Joby Aviation says that, you guys are trying to make this type of travel a reality for your typical and average American. So what is the cost of one of these flights going to be?
It's a really good question, Kristen. And everything about this aircraft was designed to be affordable and accessible from day one. So the capacity of the aircraft, the speed of the aircraft, the sort of reduced charge time, were all to ensure that we could drive to a price point that started affordable and got progressively more affordable in time. So we've messaged in the analyst presentations that we're expecting to start at sort of roughly $4 per passenger seat mile, driving down over the first 2 years to something like $3 per passenger seat mile. So folks can think about that as sort of kind of a little bit below the cost of an Uber Black today, getting down to the cost of an Uber X. And at those price points, we think this is a mode of transportation that can really be affordable and accessible to everyone.
And I want to ask you about Pinterest in just a moment. But before I do, I want to quickly ask you, because I know Joby Aviation is set to go public in August after a shareholder vote. I'm curious to know if you can tell us a bit about your plans after that IPO and what's coming next.
Yeah, so for us, the sort of opportunity to go public now really wasn't based so much on market conditions, but instead about the company's readiness across the things that we're going to have to execute over the next stretch. So we feel really good about where the technology stands, obviously as demonstrated by the flights this week. And what's going forward is really the execution of a certification plan that has now been sort of broadly agreed to with the FAA with our receipt of the G1 issue paper. So our approach over the next 3 years are going to be quarter by quarter to execute against the things that matter to build this business. First, certification, second, manufacturing, and third, service design and rollout.
I, of course, want to ask you about Pinterest because you are one of Pinterest's co-founders. Pinterest really getting slammed today, down 18.5%. That is, of course, on the news that monthly average user figure has fallen. And Pinterest really did so well during the pandemic as so many folks turning to Pinterest for recipes and I'm assuming new ways to bake bread. I'm curious to know what you think is coming next for Pinterest, especially as we move out of the pandemic. Folks are excited about getting back outside, about some of the growth there and some of those average users every month.
Yeah, well, I certainly can't speak to the specifics of this quarter, Kristen, but look, I've always had confidence in the product and in Ben and the sort of broader team there. So I think that the company is going to continue to sort of execute well over the next stretch.
All right. A nice bull and optimistic tone being struck for Pinterest. Paul Sciarra, Joby Aviation's Executive Chairman, thanks so much for joining us today. The latest luxury outlook report from Sotheby's International Realty is here with some surprising details. We're joined now by Bradley Nelson, Sotheby's International Realty Chief Marketing Officer. So Bradley, I first want to just start with the pandemic and its effects that have been had on the luxury real estate market. What have you seen happen over the last year?
Well, Kristen, thanks for having us. The pandemic has certainly had a significant impact on the luxury housing market, really creating a level of demand that we have not seen in many years. This has really been driven by the fact that our homes have played double or triple duty in our lives during the pandemic as they became places where we're working, places where families are educating children, and in general, where we're spending so much time. And as a result of that, clients, particularly those with the capability to work remotely, have driven to finding larger homes and also homes that have greater access to outdoor space.
Yeah, absolutely. I think anyone that lives in New York knows the struggle of being stuck in quite a small apartment day in and day out while you are working from home. Now, Bradley, I think when most people think of the luxury real estate market, some of these dream homes, we start to think of folks that are just a little bit older. I'm curious to know if there was any shifts at all, at least in the ages of people that you are seeing purchase some of these essentially higher ticket homes.
Absolutely. I think that many in the housing industry have been wondering when the millennial generation was going to step into the housing market and the luxury sector in earnest. And 2020 and into 2021 is definitely when we're seeing that show up. I think it's a convergence of many factors. First and foremost, millennials are really beginning to enter their prime income earning years as they advance in their careers. And then secondarily, we have the greatest wealth transfer in the history of the world taking place right now as well. I believe the Wall Street Journal recently reported that $35 trillion has been saved by prior generations, and millennials are just now beginning to inherit that, which is changing their purchasing capability. We're starting to see them be interested in different types of communities, particularly those that are highly amenitized. So you can think of traditional golf course communities, et cetera. Those have been interestingly attractive to this next generation of buyers.
I'm very glad you mentioned that, because that was one of the surprising tidbits, I think, from the survey and from the study, that folks my age are moving into communities that I think we more associate with folks of the retirement age. Is it the amenities that have made it so attractive to some of those millennial buyers?
I really do think so. So like us, if you live in New York City, you're accustomed to living in a building that might have a lot of amenities and services. And the concept to moving to a suburban environment where all of the responsibility of maintenance is on your own. Some of these golf course communities, other amenitized neighborhoods, they really offer some of those similar services. They also offer a sense of community. And I think as we're coming out of a season where many of us perhaps spent more time alone than we're accustomed to, perhaps that built-in sense of community as you're moving into a new part of the country or a new area might be really attractive as well.
I want to ask you, however, especially, I'm here in New York, and I think that we've all heard that New York is back. It was never going out of style. Are you seeing some folks moving back to the cities and back to urban areas? And if so, what are the kind of properties that they're looking at in the cities?
So absolutely. For those of us who are New Yorkers, there was a great expression trending on social media, New York or nowhere. And I think it really captures the spirit of what this place is and how resilient not only New York, but lots of cities are. And obviously, we've seen massive population migration to higher density locations for many years. We think that buying in New York over the last decade is going to have proven to be, over the last year, will prove to be a very smart decision as we begin to see buyers come back to the market. I don't know that the trends that you're seeing elsewhere in the country and the world are any different here in New York City. So I do believe that clients are looking for larger apartments so that if they are spending more time working from home, they have a dedicated space to do that. I also believe that we're looking for places that are in closer proximity to our work. So instead of living and working in two different neighborhoods, we're seeing clients really look for properties that are within walking distance of either their children's school or their employment.
And I want to just very quickly ask you, Bradley, before we go, how long you think some of these trends are going to really last now that we are trying to see the other side of the pandemic, folks are returning back to the office?
So I believe that clients are going to return back to major cities. I think if you purchased a home in Colorado, for example, and have been living there, you're now being called back to work. It might make a great deal of sense for you to keep that property, to use it as a vacation rental investment, whether that's Airbnb, Vrbo, et cetera. I think the one trend that's really here to stay, though, is actually how we shop for a home. And at the height of the pandemic, we were introduced to so many new technologies, whether that was virtual reality, video tours, and they have proven to be a more efficient way for buyers to look at homes instead of running around to 25 open houses every weekend. And I believe that some of these digital technologies to help buyers narrow down their list and focus on which home is right for them is really here to stay. And as a result of that, if you're selling a property, as you look for your next one, I think it's really important to ask your broker or your agent how they're taking advantage of those convenience factors that's going to make your property accessible and attractive.
All right, we'll have to leave that there. Thanks so much, Bradley Nelson, Sotheby's International Realty Chief Marketing Officer.